Today, will banks be stressed too? Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news with a distinctively Australian flavour. Well, we just got the results of the Reserve Bank of New Zealand's stress tests. And this week, the RBNZ undertook both its regular solvency stress tests for the banks, which is challenging the resilience of banks' capital to a severe downturn. And also, they put the spotlight on banks' liquidity and funding resilience through a liquidity stress test ahead of next year's review of the liquidity policies from the bank. The solvency stress test included the 5 largest banks: ANZ, New Zealand, ASB, BNZ, Westpac and Kiwibank. And the liquidity stress tests featured those 5 plus Co-operative Bank, Rabobank New Zealand, Heartland, SBS and TSB. Now, the bank is at pains to highlight the stress test scenarios are hypothetical and don't represent its view of the most likely future path for financial stability risks. And they also don't release individual banks' stress test results, like the results from the Federal Reserve in the US, where individual bank results are disclosed. In this respect, New Zealand is following the opaque strategy that APRA also executes here in Australia, which is a pity, not least because in New Zealand, bank deposit bail-in is a thing via the open banking resolution. And the Reserve Bank of New Zealand has warned people to do due diligence on individual banks. So why don't they disclose the detail, we ask? The liquidity stress test was the Reserve Bank of New Zealand's first banking industry test focused on liquidity since 2003. It featured adverse and very severe scenarios to assess the resilience of banks to a bank-specific event. Disruption included a cyber attack, IT systems disruption, or fraud leading to reputational damage, and a significant share of the bank's funding being withdrawn or no longer available within a short space of time. The scenarios included a set of weekly outflow and other assumptions over a 6-month period. That's longer than the usual liquidity requirements. Banks applied those assumptions to their March 2021 balance sheet to determine their weekly net cash outflows and liquid asset balances. That can be cash or assets that can be readily converted to cash. And the survival horizon, the number of weeks before liquid assets can no longer meet their net cash flow outflows. The very severe scenario assumptions were designed to test the limits of banks' liquid asset balances in meeting cash flow outflows without mitigating actions, the bank said. For the first time, the solvency stress test was split into 2 stages, with banks required to choose mitigation actions and submit their results after the first year of the shock without knowledge of the length or severity of the shock, which was subsequently provided in stage 2. This prevented banks gaining perfect foresight of the scenario and allowed them to exercise greater consideration when selecting their mitigation actions, they said. It also allowed the bank to incorporate the health of the banking sector after year 1 of the exercise for stage 2 of the scenario design, the bank said. In the first year, the New Zealand economy experienced a severe recession for the first 6 months as a global COVID-19 resurgence bites, resulting in widespread lockdowns and an economic downturn. Prior to 2020, the Reserve Bank had never included a pandemic in bank stress testing. Economic activity is dragged down by sustained border restrictions both in New Zealand and abroad, they said. Domestic lockdowns and social distancing measures, persistent economic uncertainty, subdued consumer and business confidence, and weaker global demand for New Zealand's exports. The containment measures heavily affects the retail, tourism and hospitality sectors in particular. Additionally, they say, a drought strikes the whole of the North Island in 2021-2022 season, and that drought affects both dairy farms and the remainder of the agricultural sector in the North Island. And in response, milk production by North Island dairy farms is reduced by 7% from the previous season, while a greater resilience on purchased feed and supplements increased their expenses by 9%, the bank said. And during year one, house prices fall by 20%. Commercial property prices fall by 26%. And New Zealand's real gross domestic product contract by 8% on average, and the unemployment rate reaches 10%. Also, credit spreads widen due to the increased global uncertainty, which increases overall bank funding costs. Government and Reserve Bank policy responses include a large fiscal support package, albeit slightly less than that in 2020, cutting the official cash rate to 0.5%, and additional purchases of government bonds up to $100 billion New Zealand as part of a large-scale asset purchase program. The unemployment rate rises as high as 11.8%, and house prices fall by as much as 39%. And the scenario is assessed as a 1 in 50 to 1 in 75 year event, similar to the pessimistic baseline scenario in last year's Reserve Bank of New Zealand stress test, but less severe than the very severe 2020 scenario. The aggregate overall loss rate, total impairment expenses, as a percentage of credit balances was 3.2%. That was lower than the 2020 pessimistic scenario baseline loss of 4% due to the bank's lower loss rates on mortgages and smaller business portfolios in 2021. The collateral for mortgages and potentially for smaller businesses has recently strengthened due to the increase in asset prices and stronger balance sheets heading into this year's stress test, said the bank. Impairment expenses contributed a 4.7 percentage point reduction to the change in the aggregate total capital ratio. And meanwhile, residential mortgages made up 30% of total impairments, well below the 63% of total bank credit exposure mortgages account for. And the residential mortgage loss rate of 1.5% is lower than other portfolios because borrowers continue making mortgage payments for as long as possible during stress periods, even when they're unable to pay other loans, the bank said. The loan-to-value ratio restrictions and an increase in the equity of home-owning households from house price growth in recent years contributed to reduced losses for banks on defaulted loans, they said. And the results showed that 4 of the 10 banks in the adverse scenario and only 1 bank in the very severe scenario had a survival horizon of more than 6 months. The scenario had a greater effect on the larger banks' customer withdrawals, leading to those banks having a shorter survival horizon than the smaller banks. Banks were permitted to use mitigating actions to improve their survival horizon, so long as the actions were already contained within their contingency funding plan. The most common actions taken by banks were to reduce the growth of new business, in some cases stopping lending altogether, using parent bank support, and increasing deposit pricing in order to reduce outflows or to attract new deposits, the bank said. The scenarios assumed no systemic stress and that any overseas parent bank was unaffected, which of course may not be realistic if this is an international crisis. The Reserve Bank of New Zealand sees benefits in repeating liquidity stress testing on a regular basis to monitor longer periods of stress to complement current prudential requirements that require banks to hold sufficient liquidity assets to survive stress over 1 week and 1 month. And significantly, they said that this exercise will be used as an input into their forthcoming liquidity policy review. The stress test assumptions were benchmarked against the Reserve Bank of New Zealand's 1-month mismatch ratio calculation, the 2 scenarios contained in the 2019 European Central Bank liquidity stress test, plus historical experience, and were discussed with the Australian Prudential Regulatory Authority. The median bank's survival horizon is 21 weeks in the adverse scenario and 11 weeks in the very severe scenario. That compared to the ECB exercise of 25 weeks for their adverse scenario and 17 weeks for their extreme shock scenario. The shorter duration experienced in the tests in New Zealand was due to a combination of the starting position of the banks and the stress test assumptions, especially their higher outflow assumptions in the first months of the test, which would deplete banks' liquid assets more quickly. Larger banks had a much shorter survival horizon in both scenarios than the cohort of smaller banks. In the very severe scenario, some of the largest banks fell into deficit fairly quickly following the 1 month period of maturity mismatch ratios. The driver of the difference in outcomes between the large and small banks was the difference in funding compositions. And that was also consistent with the ECB finding that globally, systemically important banks are in general hit hardest by the 2019 shocks, owing to higher resilience on less stable deposit types and wholesale funding. The average large bank's share of market funding plus large deposits, which attract the highest outflow rates, was 25% of total funding, compared to just 10% for the smaller banks, the Reserve Bank of New Zealand said. And larger banks were left with a much higher deficit than the smaller banks at the end of the 6 months. A bank's survival horizon was driven by its opening liquid asset position and its funding composition. And the survival horizon was longer if the bank held a higher level of liquid assets, which provides a stronger buffer to offset outflows. A higher proportion of smaller depositors, which have a lower outflow rate assumption than larger depositors, with the assumption being that larger depositors are likely to move banks in stress, more fixed-term funding and a longer maturity, and a larger proportion of secured than unsecured wholesale funding. Banks were allowed to use mitigating actions to address the liquidity deficits if they were already contained within their contingency funding plans. The main mitigating actions include a reduction in new lending, which was identified by nearly all banks, with some halting lending altogether, large group support, either through borrowing from their parent bank or capital injections, raising deposit rates in order to reduce outflow and even attract new deposits from competitors, and increasing the bank's capacity to borrow from the Reserve Bank of New Zealand via extended internal residential mortgage-backed securities. Banks commented that the exercise worked well, notwithstanding some data collection difficulties, and there were a number of benefits they gained from their internal stress testing. The exercise provided a cross-check of their internal stress test assumptions and additional scenarios to use, and also confirmation and testing of their contingency funding plans and the use of a more granular set of data from the liquidity stress tests for their internal stress testing, and expansion of their liquidity stress tests beyond shorter focus time horizons, the bank said. Banks had to choose mitigating actions without knowing the full impact and length of the shock, and the solvency stress tests saw the Reserve Bank of New Zealand coordinate a process where the big 5 banks used their own models to estimate the effects of the stress scenario on their capital. Banks had 3 to 4 months to submit their results, and the Reserve Bank of New Zealand then made adjustments to the submissions where bank modelling generated inconsistent outcomes compared to peer banks. Reserve Bank New Zealand modelling and experience and previous stress tests. There was minimal difference between the capital outcomes of the bank's submissions and the bank's desktop model at the aggregate level. However, there were more significant changes at the individual bank level, which we discussed with banks, the Reserve Bank of New Zealand said. The aggregate Common Equity Tier 1 capital ratio of the 5 banks fell by 3.6 percentage points from 12.9% at the start of the stress test to a minimum of 9.3%. That is well above the current regulatory bank minimum of 4.5% and shows that banks are sufficiently well capitalised to manage a COVID-19 induced economic downturn and continue to support demand for lending during such a scenario. The results also showed banks to be more resilient than in last year's pessimistic baseline scenario due to an increase in their capital buffers assisted by improved profitability and dividend restrictions, and consistent with the forthcoming implementation of the capital review, the bank said. However, The 2021 stress test results also indicate that a major stress event would make it difficult for banks to meet higher capital requirements in the lead up to full implementation of the new standards in 2028. These results reinforce the need for banks to continue to build capital and replace non-complying Tier 2 capital instruments, which will cease to be compliant under the new rules. And the Reserve Bank of New Zealand's annual solvency stress tests and banks' internal stress testing can be used to monitor this transition risk. The results of this stress test show that New Zealand's banking system has a stronger level of resilience than a year ago and is well placed to support the economy through a severe downturn. However, the current capital levels still lead to banks' capital ratios falling to well within the prudential capital buffer under the new capital framework for a scenario calibrated to be 1 in 50 years or 1 in 75 years events. More work needs to be done, they said, to ensure banks could withstand a 1 in 200 year event, the benchmark for the capital standards by 2028, the bank said. Now, there's a couple of points here. Kudos to the Reserve Bank of New Zealand for looking at both liquidity and also the other scenarios. But the real question here is, how do you look at an international banking failure, not just a local one? And is it really appropriate to assume that an individual bank is able to do a certain level of, for example, fundraising or deposit raising when everybody else will be doing the same? I don't think there's anything in this piece of modelling that suggests that their integrated approach, if you like a macro approach, which is really what's required to understand what the real scenario will be, was actually undertaken. So this is helpful to an extent. But I think also from a bail-in perspective, it does highlight that some of the smaller banks, those that have a higher proportion of their funding from deposits rather than from wholesale banking sources, are probably in a lower risk category. And that would suggest possibly that people might consider some of the smaller lenders rather than the big four or the big five. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.